Okay, here's your summary of Chapter 13 when we are talking about corporations. And again, some of these, if we talk about some of the characteristics, the advantages and disadvantages, we talked about some of these in the previous chapter. Again, some of the one of the biggest advantages is the limited liability. So owners can't be held responsible legally for things that the corporation and the owners are separate. You can raise a lot more money with this because you can sell stock to raise capital. It does have a continuous life. It's not limited to the life of its owners. Along with that continuous life here, we have easy transfer of ownership. They can sell stock at any time, and this person's no longer an owner, and a new person is, and the corporation just keeps on going. And the other thing is there's no mutual agency like we had with the partnerships, so that can really help. The disadvantages, one of the big ones being the double taxation. The corporation is taxed on its profits, and then those profits are turned over to the owners, and the owners are taxed again on whatever they receive from the business. So that money is taxed twice. Higher startup costs, and we'll just say more complex. So more complicated startup. There's a lot of different types of corporations. It varies by state, and so you're probably going to need a lawyer to help you with this part. Increased government regulation, especially if you were a publicly traded company. The government will take a much more active role in what you can and cannot do and how you report things. If you remember in Accounting 1 when we talked about GAAP, some of that stuff didn't apply if it was a small enough company, but if you're a big company, that will apply. Also, the owners and the management are separate. So, and they'll often have very different ideas. So a manager might be thinking about what's best for the company in the long run, and the owners, the stockholders, are more about the stock price right now and the return, and so they can have very different, and that's how you end up with, like, say, Steve Jobs getting fired from his own company, because the stockholders and the management are separate, and again sometimes have very different visions and very different goals. So that can be a big disadvantage there. Some things that we haven't talked about yet: stock and a stock certificate shows ownership. There's a picture in your book of a stock certificate, so that shows ownership. Also par, or sometimes you see it called stated value. Keep in mind, this is not the value of the stock. That is definitely not the market value. It's really kind of a made-up thing that they do sometimes when they first issue the stock. You can sell stock when I'm talking about selling, I'm talking about a company issuing the stock for the first time. Once it's out there, it's bought and sold among different owners for different prices. The company doesn't get that. So if I buy Citi stock for $5 and then I turn around and sell it years later for $100, that profit all goes to me. The Citi doesn't get that. They just got that initial $5 and that's it. So it's not that stock with a par value has a greater value that on the stock exchange. Sometimes I think it makes stockholders think it does, but it really doesn't mean anything. However, once you set a par, the company cannot sell the stock, cannot issue the stock for below that par value. So when you see par, it's usually going to be something very low. A lot of times you see this $1 par value, but it doesn't mean, sometimes it can it's used to determine the dividend payments, but it does not mean the stock is worth $1. Let's see. We also have, we'll see the number of shares authorized. That's how many the company is allowed to sell, but they don't have to issue those. This is the number they've actually issued, put out there, and sold. And then we'll see, outstanding. Sometimes they buy some back. That's treasury stock. We'll talk about that at the end of the chapter. So on the balance sheet, you'll see number of shares authorized, number of shares issued, number of shares outstanding. We also have common stock and preferred stock. So preferred stock, they will get paid first. If a company pays dividends, they will get paid first, and they will always get paid a set amount. After the preferred stockholders get paid, if there's anything left, the common stockholders get what's left. So it could actually be a bigger payment per share than the preferred stockholders get, but there's also a greater chance that they won't get anything. So it's kind of that risk versus return thing. The preferred stock can be cumulative or non-cumulative. If it's cumulative, if a company does not pay dividends for a couple of years and then they start paying again, they have to pay for the years they missed before they can start paying the common stockholders. Or if it's non-cumulative, if they skip a year, they just skip a year and you don't go back and pay it. And we'll talk about those too. Here's the stockholders' equity section, just to kind of show you what it looks like. The stockholders' equity has two sections: paid-in capital and retained earnings. Paid-in capital is what people paid us for the stock, and so you'll see it at par, and then this is in excess of par. So you always see the preferred stock first, then the common stock. We always put it here to common stock at par if there is a par, and if they pay us more than par, the difference goes here to this paid-in capital in excess of par. So these are the names of the accounts right here. That's the name of the account: preferred stock, $50 par value. And you see the number of shares authorized, the number of shares issued, and the number of shares outstanding. Retained earnings is sort of when a company earns an income, they can either pay it out to their stockholders in the terms of dividends, or they can keep it in retained earnings. So it's kind of, you could kind of think of it like their savings account. So it's what they earned and saved in. So they can either, keep it, and they can pull things for future development and investment, that kind of stuff, out of retained earnings, or they can pay it out to the stockholders. And then the total paid-in capital plus the total retained earnings is what equals the total stockholders' equity right there. Okay, let's look at some journal entries. When we issue stock, if there's no par, a stock doesn't have to have par, and I issued 1 million shares of no par stock for $1 a share. For $1 a share, I debit cash and I credit common stock. The amount of cash I got was $1 per share times 1 million shares. So I got $1 million, and I credit common stock for $1 million. Let's say, so this would be for no par, and it'll pretty much look exactly the same if I issued it at par or I issued it for the par value. So I issue 1 million shares. Of $1 par common stock for $1 a share. So I'm issuing it for exactly the par value. So again, I just debit cash for what I got. I credit common stock for the par value. So I got $1 million. And the par value is $1 million, which is $1 par times 1 million shares, and there is no difference. So that's what it looks like if I'm issuing, if it's no par stock, or if I'm issuing it for the par price. If I issue it for something more than par, it's called issuing it at a premium. So let's say I issue 1 million shares of $1 par common stock I issue it at $20 per share. Then I will debit cash for the amount of cash I got. I got $20 a share times 1 million shares. So I received $20 million in cash. I credit common stock for the par value. So that is $1 times a million shares. So this is at par. This is, we'll say, the market price, what I sold it for. The difference, so in this case that's 19 million, goes to that account that we saw called paid in capital in excess of par common stock. So the name tells you what it is. It's the paid in capital that we got over and above the par price. So that's the whole name of the account right there. I'll probably start abbreviating that, but we always credit the common stock or the preferred stock account for the par value, and then the difference between the cash we got and the par value goes to that paid in capital in excess. Let's look at one with a for preferred stock. It's exactly the same thing, really, though. Let's say I issue 1,000 shares of $50 par 6% preferred stock, which that's kind of how you see it. The 6% thing will tell us here about cash dividends later on. We'll use the same example later on, but that's how you'll kind of see it written. And I issue this at $55 a share. So right now I can see the par is 50 and I got 55, so I know I'm going to have some paid in capital. It's at a premium. So I'll debit cash. I got $55 a share times 1,000 shares. So I got $55,000 in cash. So that's kind of the market, or what I got for it. I'll debit preferred stock, PS preferred stock, for the par value, $50 times 1,000. So the difference, which is 5,000, goes to paid in capital in excess of par preferred stock. So it works exactly the same way. It's just preferred stock instead of common stock. And so there's a couple problems in the demo problems for you to do issuing, and you'll see it kind of a couple different ways. And you have no par, and you have at a premium, and you have common, and you have preferred, and there's actually one in there where you're exchanging a building. It works exactly the same, except instead of cash, I have a different asset in there. I have a building, so you can do it that way. Okay, let's talk about cash dividends. First of all, a company is not required to pay cash dividends. They can keep all their cash and keep pouring it into retained earnings and use it to continue to develop the company if they want. Some stockholders don't care about getting cash dividends. They would actually rather see the company reinvest that money because they're just holding that stock for they want to grow in value so that they can resell it on a gain. But some investors are buying the stock for revenue purposes and then they want a dividend. So if I'm going to pay cash dividends, if I do it, the first step is called the date of declaration. And this is when they declare dividends. They are going to create a liability here. They're not actually paying them yet. If they do it, they will when they declare the dividend, they will debit an account called cash dividends. This is actually coming from retained earnings. Just so you know, that'll get closed out to there, but that's where they're pulling that from. And they will credit dividends payable. Sometimes you'll see a couple problems where they declared a dividend of such and such per share, or sometimes you just see the total dividend, which you can see it both ways. The second thing is the date of record. There's no journal entry for this one. This just says anybody on record as of this date will get paid a dividend. So if I let's say I declare the dividend on 3/1 and then on 3/15, is the date of record. So anybody on record as of this date. If I had that stock for 10 years and I sold it on March 14th, I'm not going to get a dividend because I did not own it on the date of record. If I just bought it on that day, I'm going to get the dividend. On the third thing is the actual payment of the dividend. So let's say they pay this on 3/30, they would just debit that liability, dividends payable, for however much we put up here, and then credit cash when they pay them out. So if I was on record on the 15th, but then say I sold that stock on the 20th, even though I no longer have the stock when they make the payment, I would still get the dividend because I was on record on the 15th. So that's kind of how that one works. And there's a couple problems for you to do there. Or there's one problem where you're just paying back basic cash dividends. But let me talk about if it's cumulative preferred stock and we have to pay dividends in arrears. Let's go back to that example. Let's say there are 1,000 shares outstanding. Of that $50 par 6%, and we'll say it's cumulative preferred stock. And then I also have 1 million shares of that $1 par common stock. Now let's say I paid no dividends in 2013 or 2014, and now in 2015 I declare a $50,000 cash dividend. So since this is cumulative preferred stock, I have to pay them what I would have paid them in 2013 and 2014. Then I pay this year's preferred stock, 2015, and then if there's anything left, it goes to the common stockholders. So if we use this to figure out what their payment would be, $50 is the par value times 6%, which means each share gets a $3 dividend, and then there are 1,000 shares outstanding. So the total payment for a year to my preferred stockholders would be $3,000. So this is what I mean when they said the stated value. They will always get $3 a share. Whether they had a great year or a bad year or whatever, they always just get $3 a share. So when I pay this, the total dividends that I said I was going to pay was $50,000. I will pay the amount in arrears first. So that'll be 2013, I owed them $3,000. In 2014, I owed them $3,000. It's the same every year. So I'll pay the $6,000 in arrears first, and I'll get $44,000. Sometimes, if I'm several years in arrears, the dividend payment might not be enough to cover the entire amount that I'm behind. So I pay what I can, and I keep track of what I owe it, and I get it to the next year. But in this case, I can pay all the in arrears, so then I pay my current payment to my preferred stockholders, which again is $3,000. And so now I've paid them for 2013, 14, and 15, and I have $41,000 left, and that's what goes to my common stockholders. So even though it looks like more, that's 41,000 divided by 1 million shares, so they're not really getting too much. The journal entry would look like this at the date of declaration. I would debit cash dividends for the $50,000 total, and then I would credit dividends payable common stock, let's do the preferred stock first, and they're going to get the $6,000 and the $3,000, so a total of $9,000 to the preferred stockholders. I'm abbreviating here so I can fit this in. Dividends payable common stock, they'll get the other $41,000, And that's what it looks like on the date of declaration. And then on the date of payment, I will just debit those two liabilities and credit cash. So debit dividends payable, preferred stock, dividends payable common stock for $9,000, $41,000, and then credit cash for $50,000. So that's how we pay in arrears. One of the problems in the demo problems is this one. It doesn't have the journal entries. That's the same every time, but this is just to show you a couple different ways that you'll see this. And the issue is really just figuring out what to pay each group. So in this case, they have 3%, $14 par value. They have 7,000 shares authorized, 5,500 shares issued and outstanding. That's the relevant number because I only pay dividends on the number of shares outstanding. And then I have 20-cent par value common stock, and I have 1.65 million shares outstanding. So that's the relevant number. In scenario 1, they declare cash dividends of $20,000. How much goes to preferred? How much goes to common? So the preferred guys, again, are going to get the same thing every time. I'm going to take the $14 par value times 3%, and I get a payment of 42 cents per share times 5,500 shares. So that's a total payment of $23.10, and that's what they're going to get every year that I pay. So I would pay $20,000 would be my total. I would pay $23.10 to the preferred stockholders, and that would mean that anything left over, which in this case is $17,690, that's what goes to the common stockholders. So the second scenario says, assume that the preferred stock is cumulative and that Platinum passed on the preferred dividend in 2014 and 2015. Then in 2016, they declared cash dividends of $50,000. How much of that dividend goes to the preferred stockholders and how much goes to the common stockholders? So we'll pay, again, we'll have $50,000 here total. The payment doesn't change to the preferred stockholders. It's still this one. So we'll pay the amount in arrears first. So the arrears, they're 2 years behind. So 2 years times the $23.10, which means the amount in arrears then is $46.20. So I'll pay $46.20, and then I'll also pay them this year's, which is $23.10. That's the current. This is arrears. And so the total payment to the preferred stockholders is $69.30, which means the difference, which is $43,070, goes to the common stockholders. And then in the third scenario, it's exactly the same except it's non-cumulative. So that means it does not matter that they missed these 2 years. So I'll take my $50,000 total. The preferred guys will just get the $23.10, this year's payment, and the common stockholders will get what's left, which is $47,690. Okay, let's see. I think this one's getting a little bit long, so I'm going to stop this and then I'm going to start another video to start up with the stock dividends. So I will be right back with part 2.